Well, we're beginning our reading on intercorporate investments. 3 learning objectives, but they span the entire reading concurrently. So we're going to do this reading not by learning objective, but by section, sort of a linear approach. But I will read the learning objectives so that we're aware of what we're doing in this reading. A is to describe the classification, measurement, and disclosure under IFRS for investment in financial assets, investments in associates, joint ventures, business combinations, and special purpose and variable interest entities. B is to distinguish between IFRS and GAAP with respect to that. And then C is to analyze how different methods used to account for intercorporate investments affect financial statements and ratios. And when we mean different methods used to account for intercorporate investments, is it a financial asset, is it an investment in associate, or is it actually a business combination? So let's begin. An intercorporate investment is basically an investment in other companies or the securities of other companies. So it can be debt or it can be equity. And companies engage in intercorporate investments for a number of reasons: to diversify their asset base, to enter new markets, to obtain a competitive advantage, or to achieve additional profitability. Let's look at the basic corporate investment categories that we'll be looking at in detail. Number 1, investment in financial assets. This is just buying the debt, bonds, or stocks of other companies. No significant influence or control. Typically less than 20% equity interest. And they can be classified as either fair value to P&L, to profit and loss, fair value to OCI, or amortized cost. And we're going to go into detail on all of those 3 categories shortly. Prior to IFRS 9, IFRS 9 is the current standard for dealing with investment in financial assets. Prior to that, the categories were held to maturity, available for sale, fair value to P&L, and loans and receivables. And again, we'll go through those. Second category is investment in associates. Here we go from no influence and no control to influence but no control, typically 20 to 50% equity interest. Third category is joint ventures. This is where 2 companies have control over a particular entity. Control is shared by 2 or more entities. And finally, the 4th category, business combinations. Here we have control, represented typically by equity investments greater than 50%. Now, a word. The 0 to 20% for financial assets, the 20 to 50% for business associates, and the greater than 50% for business combinations is not a hard and fast rule. What is the hard and fast rule is the idea of influence and control. No influence, no control, it's a financial asset. Influence, but no control, that's a business associate. Control, that's a business combination. All right, let's look at our first category, investment in financial assets. We're going to look at it from 2 points in time, prior to IFRS 9 and at IFRS 9. IFRS 9 being the current standard for IFRS. We're going to look at it prior to the current standard because at that time, IFRS and GAAP were similar. GAAP has stayed there, IFRS has moved on. So in understanding that, we're understanding GAAP. So let's have a look at what we had. And again, this is prior to IFRS 9. There were 4 basic classifications of investments in financial assets. But regardless of what classification we used, they shared these 2 common characteristics. All purchases of financial assets are initially recognized at fair value. And all dividend and interest income, regardless of the classification, goes directly to the income statement. So let's look at our first one, held to maturity. Well, we have the word maturity. So clearly we're dealing with debt securities or redeemable preferred shares. These are preferred shares that have a maturity date. They would be considered debt. Fixed or determinable payments, fixed maturities. So basically debt securities that the company has the positive intent and ability to hold to maturity. We're going to revisit that statement, positive intent and ability. And we're going to see that if a security is classified as a held to maturity, there's a big restriction on changing that classification after. So as I said earlier, they're initially recorded at fair value. In this category, the held to maturity, they are amortized to par as time passes using the effective interest rate method. So they're not listed each quarter at fair value, they're listed at amortized cost. So right away, we know that's going to affect the amount of interest income that's reported on the income statement. And the interest income that is reported is the coupon adjusted for any premium or discount, because we're amortizing these to par over time. Now, if we bought a security at par and it matures at par, there is no amortization. The interest income is the coupon. If we bought it at a premium, the interest income is lower than the coupon because it's the coupon minus the amortized premium. And if we bought it at a discount, the interest income is the coupon plus the amortized discount. If we sell a held-to-maturity security before maturity, all gains and losses go to the income statement. So let's look at something called reclassification. Reclassification means that we have a held-to-maturity security and we say, you know what, we don't want to call it this anymore. Let's put it in one of the other classifications, or we sell it. That's called a reclassification. The company may lose the ability to use the held-to-maturity category if more than an insignificant amount has been sold or reclassified. So typically, once a security is called a held to maturity, a company is very reluctant to do anything but hold it to maturity, because if it reclassifies too much of it, as it says here, more than an insignificant amount, it will lose the ability to use that category. Let's go on to the next category called held for trading. And held for trading has another category that's very close to it called fair value to P&L. So there's actually two in this category: fair value to P&L and held for trading. They're treated the same way, but they have different definitions of what the security is. So let's deal with held for trading first. After that, we'll understand what fair value to P&L is. Here's held for trading: debt or equity acquired with the intent to sell them in the near term. Now contrast that with held to maturity. Held to maturity says you must have the positive intent and ability to hold to maturity. Held for trading says, I don't have that. I do want to sell it in the near term. That is my intention. So it can't be held to maturity. It must be held for trading. Reported at fair value at each reporting date. Any unrealized gains or losses go directly to the income statement. And as with every category, interest and dividends received go to the income statement. Fair value to P&L is financial assets that may otherwise be classified as held to maturity or available for sale. And they have the same accounting treatment as held for trading. So why wouldn't we just call it all held for trading? Well, let's go back to the held to maturity. If more than an insignificant amount is reclassified, you lose that category. So let's say you've lost that category and you buy some debt securities and you want to hold them to maturity. Your intent is to hold them to maturity. Well, they're not held for trading. Held for trading says you plan to sell them. So you say, well, I can't use held for trading. And the other category is available for sale. And we'll see shortly that any unrealized gains or losses from available for sale securities go to OCI. And maybe we don't want that. So we would normally call it held to maturity, but we've lost that category. We don't want to call it available for sale, and it's certainly not held for trading. But we want it to be treated the same way as held for trading, so that's why we have this category called fair value to P&L. So our first category, held to maturity. Our second category, held for trading or fair value to P&L. And our third category, available for sale. This is debt or equity not classified as held to maturity or held for trading. Initially measured at fair value, it is restated at fair value on each reporting date, pretty much the same as held for trading. Any unrealized gains or losses go to OCI instead. Held for trading, it goes to the income statement. Available for sale goes to OCI, net of tax. When it's sold, the amount in accumulated other comprehensive income will then go to the income statement because it is realized, and it goes to the income statement in a category called reclassification adjustment. Interest plus dividends, they go to the income statement, and the interest, of course, is calculated using the effective interest rate method. If there are Forex effects, by Forex we mean I'm a Canadian company. Let's say that I have some debt securities in my available for sale category, and I list them at fair value. But the currency also has an effect on the value. For IFRS, it says you must separate the change in fair value from the Forex effect. The Forex effect goes right to P&L. The change in fair value, of course, stays at OCI. For GAAP, it just all goes to OCI. It doesn't make a big deal about separating out the Forex effect. The fourth category, loans and receivables. These are non-derivative financial assets with fixed determinable payments, so basically debt securities. IFRS typically carries them at amortized cost. GAAP can carry it at amortized cost, fair value to P&L, or fair value to OCI. if it meets the legal definition of a debt security. So let's just do a little walk through Exhibit 2 here. This is the Volvo 2011 Annual Report, notes to the consolidated financial statements for recognition of financial assets. And we should understand everything that's written here now. We don't have to read the first paragraph, that's preamble. Let's go to the second. Financial assets at fair value through profit or loss. All of Volvo's financial assets that are recognized at fair value in profit and loss are classified as held for trading. You'll recall in this classification, we said they can be called held for trading, or they can simply just be classified as fair value to P&L if we don't want to call them held to maturity or available for sale. Well, they're saying if it's going to the income statement, they're all called held for trading. This includes derivatives to which Volvo has decided not to apply hedge accounting, as well as derivatives that are not part of an evidently effective hedge accounting policy pursuant to IAS 39. We didn't talk about this at all, so we can ignore that. Gains and losses on these assets are recognized in profit and loss. Financial assets classified as available for sale. Recall that this category, all unrealized gains or losses go to OCI. Let's see if it's consistent. This category includes assets available for sale and assets that have not been classified in any of the other categories. These assets are initially measured at fair value, including transaction costs. Any change in value is recognized directly in other comprehensive income. The cumulative gain or loss recognized in other comprehensive income is reversed in profit and loss on the sale of the asset. Unrealized declines in value are recognized in other comprehensive income unless the decline is significant or prolonged. Then the impairment is recognized in profit and loss, and we haven't hit impairment yet, but we're going to see that's consistent with how IFRS treats impairment for available for sale securities. If the event that caused the impairment no longer exists, impairment can be reversed in profit and loss if it does not involve an equity instrument. If it involves debt, we can reverse it. If it involves equity, what happens is the new fair value is simply just already reflected in OCI because it's already carried at fair value, and the unrealized gain would just be a new addition to the accumulated other comprehensive income. Earned or paid interest attributable to these assets is recognized in profit and loss as part of the net financial items in accordance with the effective interest method. Dividends received attributable to these assets are recognized in profit and loss as income from other investments. So that's consistent with all four categories where any interest or dividends go directly to the income statement. If assets for sale are impaired, the impaired amount is the difference between the asset's cost, adjusted for any accrued interest if applicable, and its fair value. However, if equity instruments such as shares are involved, a completed impairment is not reversed in profit and loss. On the other hand, impairments performed on the debt instruments, interest-bearing instruments, are wholly or partly reversible in profit and loss in those instances where an event proven to have occurred after the impairment was performed is identified and impacts the valuation of that asset. And we have impairment coming up, so maybe we're jumping ahead a bit, but it's probably nice to have a look ahead. IFRS is saying, look, if there is impairment on a debt security and that impairment goes away, you can reclaim it back. We're going to see when we get to impairment with GAAP. GAAP says, no, it's a one-time move. As soon as you take the impairment, you can't go backwards. Well, those are our four categories. We touched briefly on the idea of reclassification when we talked about the held to maturity category, but we didn't mention it for the other category. So let's look at reclassifications now for both IFRS and GAAP. IFRS really restricts reclassification almost across the board. If you have a held to maturity security and you want to reclassify it as available for sale, you can do that if there is a change in intention and ability to hold the security to maturity. But again, the same warning applies. If you do more than an insignificant amount of that, you lose the held to maturity category. So even though you could, it's not done lightly. If it is reclassified from held to maturity to available for sale, it's remeasured at fair value, and any unrealized gains or losses would go to OCI, because the available for sale, any unrealized gains or losses go to OCI, and it's carried at fair value. For the fair value to P&L category, no reclassifications in, no reclassifications out. So we don't even have to worry about that. For the held for trading category, no reclassifications in, and reclassifications out are severely restricted and available for sale. Let's say that we have a debt security and available for sale, and we realize that, you know what, we're going to hold this to maturity, and we want to reclassify it as held to maturity because there was a change in an intention or ability, we can do that. Any gains or losses in the accumulated other comprehensive income is amortized to the income statement over the remaining life of the security. And when it's transferred or reclassified from available for sale to held to maturity, it is reclassified at whatever fair value is at that time. So, just to recap for IFRS, if it's held to maturity, reclassifying out of held to maturity, not really, not done lightly. Fair value to P&L, neither in nor out. Held for trading, neither in and out is severely restricted. Available for sale, this is the only one that really doesn't raise any eyebrows. If you have a debt security and available for sale and you want to reclassify it as held to maturity, okay, you can go ahead if there has been a change in intention and ability. Really, that's the only one. GAAP, on the other hand, allows reclassification between all categories when justified. However, held to maturity, still not used lightly. So if it's classified as held to maturity, reclassifying it out, same implications as IFRS. You don't do it very often. All right, let's look at some reclassifications under GAAP. And now, GAAP, as we said, allows reclassification between all the categories when justified. So try not to get too bogged down with, well, we can reclassify from this category to this and from this category to that. That's not what we want to pay attention to. What we want to pay attention to is where the unrealized gains or losses go to upon reclassification. That's it. So, first thing we'll say, the fair value of the security being reclassified is determined as of the date of the transfer. So let's say that we have a particular financial asset and we're going to reclassify it. We would not look at its fair value as of the last reporting date and reclassify that amount. We would find a new assessment for fair value today, and any unrealized gains or losses since the last fair value assessment, that we have to determine where it goes. So let's begin. Held for trading security, we want to reclassify it as available for sale. Any unrealized gains or losses will go to P&L. Any security being reclassified into the held for trading category, any unrealized gains or losses will go to P&L. If we have an available for sale security and we want to reclassify it as held for trading, remember now for available for sale, any unrealized gains or losses stayed in OCI and they built up in the account called accumulated other comprehensive income. Well, if we're transferring from available for sale to held to maturity, the cumulative gains or losses are reversed out and sent to P&L. Held to maturity. If we're going to reclassify something from held to maturity to available for sale, any unrealized gains or losses go to OCI. Now, why is that? Why wouldn't it go to P&L? Well, held to maturity, you'll recall, was carried at amortized cost. So we didn't calculate a fair value. If we're going to reclassify it into available for sale, we need a new fair value. And the gains, unrealized gains or losses in available for sale go to OCI. So at that point, all those gains or losses would just go to OCI because it was never carried at fair value before. If we have an available for sale security and we're reclassifying it as held to maturity, the fair value on the date of the transfer becomes the new cost basis for amortized cost. Any cumulative gains or losses in accumulated other comprehensive income would then be amortized to the P&L over the remaining life. That sounds like a lot, and it can sometimes be a little bit confusing to try to remember that. And the big question is, well, do we really need to know all of those little details? Overall, I would say on a scale from 1 to 10, I'd put that as a 5. I wouldn't say this is a 9 or 10 and you need to know it. I'd put it as a 5. I'd say be aware that upon reclassification, it's going to result in some kind of unrealized gain or loss going somewhere. And as an analyst, we want to say, aha, those unrealized gains or losses are not part of the operations. We want to be able to identify those to pull them out later on. Let's move on to impairments. When the carrying amount is expected to permanently exceed its recoverable amount. Now, for securities that are listed at fair value each quarter, the impairment will already have been reflected in the fair value in the market. We'll already have that listed in there. There are only 2 conditions under which we have to worry about the impairment. The first one is amortized cost. Since it's not using fair value, every quarter we have to check to see if it's impaired or not. If it is, then we'll do something and we'll see what we do. The other time that we have to worry about an impairment is available for sale. all the unrealized gains or losses go to OCI, and they build up in accumulated other comprehensive income. Well, it's listed at fair value, so fair value at all times has the impairment cost already built into fair value, but as soon as we recognize that it's impaired, saying, look, this new fair value, that is an impaired fair value, it'll never get back to what we paid. We would then take the amount in the loss that we have in the the accumulated other comprehensive income, and send that to P&L. So we'll look at how IFRS and how GAAP treat an impairment. And the difference comes in the reversal of the impairment, not so much the impairment itself. For IFRS, financial assets not carried at fair value must be reviewed for impairment each reporting quarter or each reporting period. Any impairment loss is sent to P&L immediately. So let me just repeat what I said on the last screen. If it's held to maturity, since it's carried at amortized cost and not fair value, any impairment would not have shown up in the carrying amount. We would then recognize it right away. If it's in the held for trading category, it's always at fair value, and all unrealized gains and losses always went to the income statement anyway, so nothing can be impaired there without us knowing, because it would always be carried at fair value. Doesn't apply. If it's an available for sale, it's always carried at fair value, so it always reflects any impairment anyways. The only difference is the loss has been built up in the accumulated OCI account. We need to get that out. As soon as we realize it's impaired, we need to get it out and send it to the income statement right away. A debt security is impaired if loss events occur that have a reliably estimated impact on future cash flows. So things like issuer experiences financial difficulty, default or delinquency, concessions. A concession is where I, as a bondholder, would grant the company a concession saying, well, I know you're having financial difficulty. Let's avoid the cost of bankruptcy and reorganization. You don't owe me any coupon payments, but in 2 years, you got to give me all my principal. That's a concession. And of course, bankruptcy and reorganization would be another loss event. Equity security is impaired if loss events or loss events occur that adversely affect the value of the investee. So some particular loss events could be significant changes in technology, changes in markets, the economics of the business, or even the legal environment. It's basically a significant and prolonged decline in fair value below the initial cost. Held to maturity, loans and receivables, this is debt now, is impaired if the carrying value is greater than the fair value of the cash flows discounted at the original effective interest rate. Now, as far as reversals are concerned, for the held to maturity, the loans and the receivables, because they were carried at amortized cost, if there is an impairment charge that we take, we can have reversals under IFRS only to the extent of the original impairment. For the other securities that are carried at fair value, remember, fair value will always hold the reflection of impairment or a recovery in the impairment. For GAAP, available for sale and held to maturity. At each reporting date, determine if decline in value is other than temporary. For held to maturity, it'll be written down to fair value and the realized loss will go to P&L. If it's an available for sale, the cost basis is written down to fair value, which it typically always is carried at fair value, but the realized loss goes to P&L. That's what we were mentioning before, is that yes, it always is carried at its fair value, so it's not as if you're going to have a particular impairment charge. The only thing that you have to do is make a decision saying, okay, that's impaired. If this is in OCI or AOCI, we got to get it out and send it to the income statement now. The fair value becomes the new cost basis with no subsequent reversals. So GAAP does not allow reversals, whereas IFRS does allow reversals. If fair value increases, it's treated as an unrealized gain in OCI if it is an available for sale security. So if it's a held to maturity security and we take an impairment, that's it. It stays there. If it's an available for sale security, because it's always listed at fair value, if the value then recovers, that we don't do a reversal. We don't go back to the income statement and say, give me that stuff back. We don't do that. The unrealized gain or loss would simply stay in OCI. Let's move on to IFRS 9. What IFRS 9 has done is it said, okay, you've got all of these labels for these categories. Let's get rid of that. Instead, let's just focus on how the unrealized gains or losses are treated. So there's only 3 categories. There's fair value to P&L, there's fair value to OCI, and there's amortized cost. And on the next screen, we'll look at a flowchart to determine how we classify each security, how we would know which of these three classifications we want. In IFRS 9, as with the previous standard, all financial assets are initially recorded at fair value, and all interest and dividend income will go to the income statement. Okay, so we have three classifications: fair value to P&L, fair value to OCI, and amortized cost. And we can either buy debt or equity. So let's start with debt. Let's say we buy debt. We have two questions that we would answer. Question number one: is the business objective for financial assets to collect contractual cash flows, and are the contractual cash flows solely for principal and interest? And if we say yes, I put money in the security so that I can get interest income, and the security really is a debt security. If the answer to that is yes, then we have a choice. Do you want to designate it as fair value to P&L? In other words, do you want to list it every reporting quarter at fair value and send the unrealized gains or losses to the income statement? If we say no, we don't want to do that, then it's either amortized cost or fair value to OCI. It's amortized cost if we're going to hold it all the way to maturity. It's fair value to OCI if we think we may sell it, but we don't have any intention to sell it, but maybe we want to sell it. So then we'd put it in fair value to OCI. If it's equity, we ask ourselves, are we buying this equity to trade in the near term, or are we buying it as a position in a competitor or a supplier, whatever the case is? So the first question we ask, is it held for trading? If the answer is yes, right away, that's fair value to P&L. No questions asked. If the answer is no, we have a choice that we can make. Do we want it in fair value to P&L, or do we want it in fair value to OCI? Now, for IFRS 9, this is important. The answer to that question is irrevocable. So let's go through that again. If we buy equity and we plan to trade it in the near term, it is held for trading. It is fair value to P&L, period. If we have no intention of trading it in the near term, or at least that's not why we bought it, we can make the choice. Do we want it as fair value to P&L, or do we want it as fair value to OCI? Once we make that choice, it is irrevocable. No reclassification permitted. All right, let's walk through one of the problems in the reading. In this example, two fictitious companies are used. On January 1st, 2011, Baxter invested £300,000 in cartel company debt securities with a 6% stated rate on par value payable each December 31st. The par value of the securities was £275,000. We paid $300,000, so we paid a premium. On 31st of December 2011, the fair value of Baxter's investment in cartel is $350,000. So we paid $3,000, now it's worth $350,000. We were getting a 6% stated rate on par. Par is $275,000. So let's see. Assume that the market interest rate in effect when the bonds were purchased was 4.5%. If the investment is designated as held to maturity, the investment is reported at amortized cost using the effective interest rate method. A portion of the amortization table is as follows. So end of year 0, that's when we bought it, $300,000. So it enters the books at $300,000. Remember, in all categories, they enter in at fair value. Since this is held to maturity, it's amortized to par over time. Interest payment, $16,500. Interest income, $13,500. So how do we get this $16,500 and the $13,500? It tells us right at the bottom, 6%. Coupon rate on a par value of $275 is $16,500, so we're going to get a coupon of $16,500. But we paid a premium for it. So we have to amortize it down to par, which means our interest income will be lower. So the effective interest rate method says, okay, well, 4.5% times the carrying value of $300,000, $13,500. So $13,500 is our interest income. If our interest payment is $16,500, we have an amortization of $3,000. By the end of the year, it'll be carried at $297. Next year, still $16,500 is the coupon, but our interest income is a little bit lower because we have the $297, and we multiply that by 0.045. We'll get $13,365. The difference between $16,500 and $13,365, our amortization is now $31,35. So at the end of the year, it'll be $293,865, and we just keep going that way. The question asks this: how would this investment be reported on the balance sheet, income statement, and statement of shareholders' equity at the end of the year, December 31st, 2011, under either IFRS or US GAAP? And it says in brackets, accounting is essentially the same in this case, and it is. if Baxter designated the investments as held to maturity, held for trading, available for sale, or designated at fair value. So let's go through each one. Held to maturity, well, we have the table up here. What goes to net income? Well, it's the interest income, but the interest income is the coupon payment less the amortization. So our interest income is $13.5. So we can say $13.5 goes to net income. It's carried at its amortized cost. So on the balance sheet, it'll be listed at $297. And OCI, nothing in OCI. If it's fair value to P&L, well, right away we know OCI is nothing. If it's held for trading, we know OCI is going to be nothing. That's easy enough to fill in. It will always be $13.5. This will always be $13.5 in the first year because we paid a premium, so the interest income is the coupon minus the amortized cost, but it's listed at its fair value. So at the end of the year, in both cases, it'll be listed for $350,000. What do we do with the other $53,000? Because its carrying value is $297 at the end of the year. We have $350,000, so we know that $53,000 is our unrealized gain. That goes to the income statement. There we go. Available for sale. Again, all interest goes to the income statement using the effective interest rate method because we did pay a premium. Our carrying value at the end of the year is $297, but it's listed on the balance sheet at fair value, so it will be listed at $350,000. So $350,000 at $297 is a difference of $53. All unrealized gains stay in OCI at that point. Let's do the second part of this question. How would the gain be recognized if the debt securities were sold on the 1st of January 2012 for $352? Well, for held to maturity, we have a carrying cost of $297 at the end of the year. That's December 31st. So it was sold on January 1st for $352. We have $55,000 that would be recorded on the income statement as a realized gain. For fair value to P&L, it's listed at $350. We sold it for $352. That'd only be a $2,000 gain because we've already accounted for the $53,000. Same with the held for trading. It's $350,000 on the books. We sold it for $352. There is a realized $2,000 gain. Remember, we've already sent the $53,000 to the income statement already. For available for sale, we sold it for $352. What goes to the income statement? Well, the difference between $352 and $350 is $2,000. Plus, we remove this out of OCI and we send that to the income statement. Plus $53,000 gives us $55,000 in that particular case. I'll leave question 3 and 4 for you. So that seemed like a lot to go through. We're done with the investments in financial assets for both GAAP and IFRS. What was the point of all that? A lot of complication there. We don't want to be an accountant, so let's bring it back to being an analyst here. We want to evaluate company performance separate for operating and investing activities. All of what we just went through, these are investing activities, but we can see that in many cases they impact the income statement. Interest and dividend income go to the income statement. Any unrealized gains or losses in the held for trading or the fair value to P&L go to the income statement. Any reclassifications, if there's any unrealized gains or losses, they go to the income statement. So net income becomes a very muddy number for us. So if we want to measure operating performance, we have to say, well, hang on a second. These are all investing activities. Let's back this stuff out. So analysis of operations should exclude interest income, should exclude dividend income. It should exclude gains or losses on investments. And when we look at our assets, we would look at these financial assets and we would say those are non-operating assets. Sure, they're assets. They may be working capital assets, but they're non-operating assets. So we would exclude those, exclude any non-operating assets if we're calculating anything to do with operating assets, return on operating assets, net operating assets, etc. All right, we're on section 5 now, which deals with associates and joint ventures. And while they are different, an associate is Significant influence, 20 to 50% voting rights, but no control, whereas a joint venture is jointly controlled. Why they're grouped together is because they both use the equity method of accounting for the investment. So what is that all about? The investment is initially recorded at cost of acquired shares, whatever you bought. Notice that we're talking about shares now because we're talking about influence and control. We're really moving to voting rights. So it's not just debt. Now we're actually just with equity. We don't have to worry about debt. We're just with equity here. Each subsequent period after we incur the cost of the acquired shares, it is adjusted for proportionate share of the changes in the investee's net assets. And you know what? With accounting, I hate words because you'll read a paragraph that to the accountant who wrote it makes perfect sense because they can see it in their mind. But unless you actually see an example of it, the paragraphs mean nothing. I think accounting textbooks should lead off, here's an example, and then give us the description of what just happened instead of giving us the description and then looking at the example. It's frustrating. Anyways, there are the words. They're frustrating if you don't know where we're going. So I'm going to get right to an example very quickly here. So what we're going to do is look at the proportionate share of earnings. We're going to add that to our income statement. So let's say we own 40% of another company and they report earnings of $100,000. Well, we'll report $40,000 of that on our income statement, minus the proportionate share of dividends. Whatever we get back, we're holding an investment on our balance sheet. We'll subtract it by that proportionate share of dividends, balance sheet only. And these two lines will require separate disclosure. Classified as non-current assets, whatever asset, whatever interest we have in a particular company. If we do consider it an associate, there is a line item on the balance sheet in non-current assets. So let's just get right to an example to see what it looks like. Okay, and I'm going to give you an example with the journal entries associated with this. So let me just give me a second here, put my pocket protector on. There we go. Okay, so now I'm ready to talk like an accountant. ABC purchases 20% interest in XYZ for $480,000 on January 2nd, 2013. Bought 48,000 shares at $10 per share. There's your 480. How do we account for that? And let's assume because we have 20% interest, we're going to account for it now with the equity method. We have influence but no control. We would have an asset account in non-current assets called investment in associate. And there we would put the amount of 480, and obviously cash is left for 480. It only affects the balance sheet. So we have a new asset account. If we look under non-current assets, investment in associates, that represents our 20% share in XYZ. XYZ reports net income of $200,000 for 2013. We bought this on January 2nd, so for 2013 they have $200,000. Here's what's going to happen. We'll increase our investment in associates by that $40,000. By $40,000. Why $40,000? We have a 20% interest of $200,000. $40,000 of that belongs to us. And on our income statement, we have a line item called investment income or loss of $40,000. Notice that we handle everything with two lines. One line in the balance sheet called investment in associates, one line on the income statement called investment income. So as we recognize investment income, we increase the value of our investment in associate. December 31st, the fair value per share is $12. No changes. No changes. We don't account for it with fair value at all. We just use the equity method. So we don't have to worry about adjusting it for fair value. January 28th, 2014, a cash dividend of $100,000 is paid. Well, 20% of that is ours. So cash, we're going to receive $20,000. And because dividends reduce the value of the firm that issue it, we reduce investment in associates by the same $20,000 as well, and that's only recorded on the balance sheet. Notice something here. This is really important. Dividends and fair value do not affect net income. Dividends and fair value do not affect net income. Dividends increase our cash, but reduce our investment in associates. So what is our investment? It was 480. We added 40. We're at 520. We took off 20. It's now on the balance sheet at 500. The only thing that went on the income statement was our proportionate share of the associate's income. Any dividends don't even touch the income statement. Any changes in fair value don't touch the income statement. So When we have an investment in an associate and we're carrying it at 5, the fair value, as we see up here, is significantly higher. Well, that has an implication for an analyst when you're looking at a company that has a lot of these investment in associate accounts, is what is the fair value of all of those? And we will see that must be disclosed, typically in the footnotes, that the fair value is disclosed. So you will want to look at the carrying value on the balance sheet. You want to go to the notes to the financial statement for that balance sheet account and look at what the fair value is so that you can come up with a better valuation for the company as a whole. Okay, let's follow an example through several years, and we'll follow the evolution of the investment in associate account here. Let's get our scenario down. Our income and our dividends look like this for 2010, 11, and 12. And let's assume that we have a 20% interest for $200,000. So we'll have an initial cost of $200,000 to open up our new asset account. At the end of 2010, we account for the income and the dividends as follows. We have a 20% interest, so income, we'll claim $40,000 and we'll add that onto our income statement, plus $40K. That'll go right on a net income. There's no tax associated with that because that's the net income of another company. They paid the tax. We're just claiming that to show the earnings power of our investment on our net income, right? Paid dividends of $50,000, 20% of that is 10, so it reduces our asset account by $10,000 and increases our cash account by 10. Same thing with 2011, 20% of the $300,000 is $60,000, goes right to income statement. Our dividends reduce our holding by $20,000, that increases our cash. And again, you can see the same thing we're doing for 2012. So 200 plus 40 minus 10 plus 60 minus 20 plus 80 minus 40, 310. That's the carrying value at the end of 2012 of our 20% investment in this company. Its fair value may be quite different and typically would be quite different than whatever we're carrying it at. So as the analyst would say, okay, well, we have 310 there. What is the fair value of that asset? Let's have a look at that. Okay, so the examples we've looked at have been quite neat. They've assumed that if we own 20% of a company, that we actually have 20%, that 20% of the net assets actually equal what we paid. That may not be the case. So there are two issues that we have to deal with, and I'll cover off the first one now. The second one I use within an example, so I'll highlight the second issue when we get to it. Number one, the first issue, what if the acquisition cost does not equal book value on a percentage basis? So let's say we buy 20% of the company for $1 million, but 20% of the book value is not $1 million. That's the more common scenario where it doesn't equal. So let's just go right into an example because, again, it just works better if you can see some transactions and some examples to explain it rather than words. January 1st, 2014, my company buys 25% of your company for $8.5 million, but the book value of your company is $30 million. So I paid $8.5 million, I got 25%, but 25% of your book value, you got $30 million, 25% is only $7.5 million, there's $1 million excess. $1 million excess. So the question we have to ask when we have excess is, well, why is there excess? Differences are first allocated to specific assets. If we can identify where the excess comes from, we would allocate that excess to those specific assets. And I know that's starting to sound complicated, but let's just take it step by step. We got $1 million. What do we do with it? Let's assume that depreciable assets are undervalued by $2.4 million. So that you really don't have $30 million, well, you may have $30 million of book value, but we think that you have $32.4 million when we look at fair value. So we look at the fair value of your depreciable assets. They're undervalued by $2.4 million. Since we have a 25% interest, 25% of that is $600,000. So we've accounted for $600,000 of the million. The other $400,000 we will call goodwill. What do we do with this $600,000 now? Well, these assets have an 8-year life, let's say. So we're going to reduce our investment in associates by $75,000 a year, which reduces investment income as well. Now this is getting a little tricky, so let me see if I can't give you a high-level view on this. If I buy 25% of your company for $8.5 million and 25% of your book value is $8.5 million, I'm done. I'm good to go. That's it. All the examples we've done apply.
I take my share of your net income and I add it to my investment in associate account. I take the dividends and I reduce it. If I pay more than that book value, that excess amount, well, that's got to go somewhere. I got to call that something. Something has to happen to that $1 million. So what I'm going to do is I'm going to look at the fair value of your assets. And I'm going to say, okay, well, can I attach it to the fair value of those assets somehow? If I can't, I got to call it goodwill. So if I can, I will do that. If I can't, I'll call it goodwill. Okay, there's step one. Step number 2 after this, on the next screen, we're going to see how do we actually deal with this extra 6 and how do we deal with this goodwill now. So for the 6, we're going to depreciate that. We are going to depreciate. We're going to reduce our $8.5 million faster than the dividends that are paid to us by $75,000 a year to bring the fair market value of the $1 million excess, the $600,000, down to 0. The $400,000 we really can't. That's tested yearly for impairment. So let's just look at an example and see how that flows. All right. I'm going to set up your example here, and I'm going to introduce issue 2 at the same time. We may as well do it all at the same time. So the first issue is we paid too much. Issue number 2 is that we're going to have more than just net income. We're going to have different types of net income, or different types of income, sorry. So let's say that your company reports net income of $2.8 million for 2014. Normally, I'd take 25% of that, $700,000, and we'd be done. But we've got some mess here, don't we? The other issue you have is this $2.8 million includes a loss on discontinued operations of $400,000. So without this, you would have reported $3.2 million, but you have this loss on discontinued operations. Well, that's another issue that we have to deal with, because now you have different types of income, and we have to claim our proportionate share of your income as you make it. As you earn it, we have to claim it the same way. And then finally, dividends declared and paid on December 31st, 14 of $1.4 million. Now, this looks daunting. It's like, how do we even approach this? Well, we just do it step by step. What's the first thing we did? We made an investment in associates. So let's just record that. Let's set up our asset account so that we can see what adjustments we make, right? Investments associate $8.5 million, cash $8.5 million. We've recorded the initial cost. Beautiful. Great. December 31st, 2014, we're going to claim our percentage of your income, share of net income as earned. All right, let's take care of that. So we're going to reduce our investment in associates by $700,000. Increase our investments in associates by $700,000. You made $2.8 million. Let's do the clean part first. You made $2.8 million. I get 25% of that. Right away, I'm going to increase by $700,000. Done. But you have a loss on discontinued operations of $400,000. So I got to claim that loss of 25% on my income statement. So on my income statement, I'm going to have a loss from discontinued operations of $100,000. And investment income of $800,000. So notice what happens on my income statement is I claim $800,000, the net income before discontinued operations. I claim that, and then I claim the loss. So I'm still only claiming $7,000 on my income statement, and I'm increasing my investment in my associates by $700,000. That's the second issue. If the associate makes net income, you claim your share of net income. If it makes other comprehensive income, you must claim that in other comprehensive income. If it has gains or losses from discontinued operations, you must claim that separately as well. It is it is reported on your statement as earned by the associate. There's issue 2 out of the way. Great. Let's keep going here. We had dividends of $1.4 million. We get 25% of that, so we'll get cash of $350,000, and we reduce our investment in associates by $350,000. And let's deal with that pesky depreciation, that extra $600,000 that we claimed as we paid in excess of $1 million. $600,000 we were able to trace to the value of equipment. Investment income or loss, we'll claim a loss of $75,000 because we'll depreciate that over the next 8 years, and we'll reduce our investments in associates by $75,000. That has the net effect of doing this. We claimed $800,000 as investment income. We're going to reduce that by $75,000. We're claiming $725,000, but we have a loss of $100,000, so we're really claiming $625,000. Had we paid $7.5 million instead, we wouldn't even worry about this last transaction. It would simply be gone, but we paid more. Now, What about the $400,000 in goodwill? That's tested for impairment annually. It's not amortized because it has an indefinite life. Any goodwill, anywhere, for any reason, anytime, under any circumstances, no matter what. One rule. Tested for impairment on a regular basis. That's it. All right, let's do another one. Make sure we understand it. Here's our scenario. We have a company. Here's its book value. Here's its fair value. We acquire 30% of this company for $100,000. So we can see our book value, our net assets are $220. We acquired 30% for $100,000. So 30% of book value is $66,000. We paid $100,000 for $66,000 worth of book value, so we paid $34,000 more than we can attach dollars to. So we have to figure out, well, what do we do with this $34,000? Well, let's compare it to fair value. Our fair value of our net assets are $270,000. So 270 minus 220 is 50,000. So we should be able to trace through 50,000 times the 30% that we have. So $15,000 is attributable to specific assets. How are they attributable? Well, let's have a look. Current assets 10 and 10, nothing there. Plant and equipment 190 to 220, so 30,000 we can find there. Of that 30,000, that's 30,000 of the 50, we get 30% of that, so 9,000 we can trace to property and equipment. That will be amortized. Whatever useful life it has, we will amortize it. Let's keep going. Land 120 to 140. There's an extra 20,000. So there's 30 here. There's 20 there. There's our full 50. Of this 20,000, 6,000 will be reflected in our investment and associate account. 6,000 in land. There's no amortization for land, so we never have to worry about that. So if we paid in excess of 34 and we can attribute 15,000 of it to specific assets, goodwill must be $19,000. So that will take us through the equity method, and we've looked at our two issues. The price doesn't equal the book value and how we deal with that. And we've looked at income as earned. We must claim it as earned. There is a fair value option. We don't have to use the equity method. There is a fair value option. For IFRS, it's extremely restricted, though, and it's restricted to companies like venture capital, mutual funds, investment trusts, where you're in the business of buying companies. They're not really associates, they're really investments designed to generate capital gains and income. You're in the business of doing that, so that you don't account for them with the equity method at all. You would use fair value method. That makes a lot more sense. A mutual fund wouldn't use the equity method if it held 23% of a particular company. Although I don't know what mutual fund would hold such a one large concentrated position. But you know what? You got to put the rule in place simply because if it can happen, let's have a rule for it, right? GAAP, all entities can do this. So how is this done? And we're not going to go into detail about this, but how is this done? So the investment is reported at fair value, which is the same with the equity method. But from period to period, as you revalue fair value, any unrealized gain or loss will be reflected in net income. Any interest or dividends will also go to net income, and any excess over book value, not amortized. So you'll record it at fair value. The next period, you'll record it at fair value. If it's higher, you have an unrealized gain that goes straight to net income. If you receive dividends or interest, that'll go straight to net income as well. Now think about the fair value approach over the equity approach. In the equity approach, you're getting your proportionate share of net income, but no changes in fair value. And interest, well, there's no interest really on equity, but we'll throw the word in there anyways. But primarily dividends. Dividends on equity do not show up in net income. They simply just reduce the carrying value of the asset. So if you have two companies, two investment companies, one using the equity method and one using fair value, that becomes very difficult to compare the two. What you need to do is for the one using the equity method, you go to the notes and you look at what the fair value is there. And you probably will have a lot of disclosures on the proportionate share of net income claim, the proportionate share of dividends. You'd have to back those out of the numbers and use fair value to get a comparable number. All right, let's move on to impairment now. IFRS and GAAP Periodic reviews of equity method investments for impairment. And the entire carrying amount is tested, not just the goodwill, the entire carrying amount is tested. If it is impaired, it's written down to its recoverable amount on the balance sheet, and whatever loss there is goes to net income. Any reversals of any impairment are prohibited under both IFRS and GAAP. Okay, transactions with associates. So we can think of the investor and the associate in sort of a relationship like this. If there's a transaction from the associate to the investor, that's called an upstream transaction. The profit is recorded on the associate's P&L. If the transaction originates from the investor to the associate, that's called a downstream transaction. The profit is recorded on the investor's P&L. So for both of these, upstream, downstream, IFRS, and GAAP, profits from such transactions cannot be realized until confirmed either through use or sale to a third party. And that makes a lot of sense, I think. If I buy 25% of an associate, and I say I have enough influence now, and I say, look, we're going to be your primary supplier. You don't need all these other suppliers. We're going to be the primary supplier. We know that you can buy something for $2, but you're going to pay us $2.20. How's that sound? You're going to pay us more. We can't record the profit on that sale until the associate can show that they can actually live with that. That they can actually live with that price. In other words, that they are actually using it at that price of whatever we sell it to them at, or that they still have the capability of reselling it to a third party. Because we could simply just manipulate at the end of a quarter, we need something, we could just sell something to the associate at some inflated price for some huge margin that might later be reversed, or that the associate would have to take an inventory write-down on. Well, there we go. There's a big problem, right? So the industry is getting very good at saying, look, if there's a way for fraud to be committed, it will be committed. So let's put it in the rules right now where it can't be committed. You had to have a lot of accountants who understood fraud, and to understand fraud, you have to be capable of it. Think about that for a minute. That it's hard to understand how to protect yourself from something you're not capable of conceiving of. So if you're not capable of conceiving of committing fraud, if it doesn't even enter your mind, it's very hard to protect yourself from it because you don't know how it could possibly happen. So being that IFRS and GAAP have gotten very good at eliminating all of this fraud, there must be a lot of fraudulent accountants working for them to conceive of the fraud they have to protect themselves from. I know it's a roundabout logic there, but if you think it through very clearly, it makes sense. Listen. Banks, I can recall back in the 80s and 90s when there were rashes of bank robberies, banks used to hire bank robbers. Professional bank robbers, they used to hire them as security consultants because you needed a bank robber to protect the bank from bank robbers. Look at casinos in Vegas. What do they hire? They hire card cheats. Why? Because it takes a card cheat to spot a card cheat. So if you want to set up accounting policies that eliminate fraud, you got to hire fraudulent accountants. If you think it through, it makes sense. Anyways, let's get back to business here. So profits from such transactions cannot be realized until confirmed either through use or through sale to third party. It is called unrealized profit. And the proportionate amount must be taken out of the investor's income from investment until confirmed. Now, you're probably going, oh, this is a lot to keep in your head. Well, you know what? This is a lot of accounting. Yes, we're stepping into the accountant's territory, and it can get really confusing unless you do this. It's pretty straightforward from an accounting perspective, but when you don't want to be an accountant, it's pretty it can sound complicated. Your goal is to just understand the impact it has on the statements, so that when you're reading statements and you see certain account names, you go, I know what that's for. I may not know all of the transactions that resulted in that account, and you don't have to. You just have to know what that account represents and how you should deal with it. That's also, we're going to show some of the transactions of how unrelated profit came into being, but I don't want you to get too into the accounting. I want you to understand the language of accounting, but what the implication is for you. How do you deal with that after? All right, let's go through an example. Let's set up our scenario here. January 1st, 2011, Wicker acquires 25% of Foxworth. I'm using the example right out of your text so that you can follow along later as well. January 1st, 2011, we acquire 25% of Foxworth for $1 million. Nice and clean. Book value of the company is $3.8 million. The fair value is $3.84. Not a lot to hang our hat on there. $40,000 extra for a building with a 20-year life. Dividends for the year are $3,200. Net income was $20,000. $8,000 of that from an upstream sale of inventory. $8,000 of it came from an upstream sale of inventory. Okay, so let's have a look at what we can do here. What's our purchase price? Start there all the time. Our purchase price is $1 million. 25% of book value is $950. Figure out your excess right away. That should be your first step. What did I pay? What's the book value? What's my excess? $50,000. Great. Can I attach that to certain assets? Well, there's an extra $40,000 for a building over its book value. Since I only have 25%, I can attach $10,000 of that 50 to something. The other 40's got to be goodwill. Great. What do I do with this $10,000? It's got a 20-year useful life, so $10,000 divided by 20 is $500 per year. Ow! Recognized depreciation expense per year of $500,000, which means I will reduce my investment in associates account by $500 a year, and I will reduce my investment income by $500 a year. Note that Foxworth is not doing this transaction. Foxworth doesn't have to worry about this transaction at all. This is your transaction to deal with, right? So 2011 investment income will look like this. 25% of the net income, there's $20,000. There's $5,000 for me. The amortization, $500. I'll reduce it by $500. But I got $8,000 unrealized profit here. Of this $20,000, $8,000 of it was from an upstream sale of inventory. Upstream means that Foxworth sold up to us. Upstream, Foxworth sold to us. Well, until we can confirm that inventory, by confirming it, it means that we've actually used it in our production process or we've sold it to a third party. Until we confirm it, that $8,000 we can't count. So we got to take our proportionate share of that out. So we have unrealized profit. If this is $8,000, we have 25%. $2,000 of that is unrealized until it's confirmed. So we'll only claim $2,500. We'll only claim $2,500 as the investment income. So what does our balance sheet look like at the year end of 2011 now? Well, our purchase price was $1 million. We increase it by our share of net income, which is $2,500, and reduce it by our dividends, which were $800. Remember, we're getting $3,200 now. 25% is $800. We're left with $1,001,700. So it may look complicated, but when you're looking at the numbers at the end of the year, you're looking at investment income of $2,500. You look at our beginning balance of investment in associates of $1 million, ending balance of $1,700. You want to try to account for that $1,700. Okay, how did that happen? Can see $2,500 here. There must be something else. And if this $2,500, is there something in here I want to be concerned about? All of these, this detail will be in the notes of the financial statement. You'll have a single line item on your income statement, $2,500, and a single line item on your balance sheet, carrying balance of the investment. Well, those two are hard to pull apart, so you're going to have to go to the notes and say, well, what's the constituents of this $2,500? Let me pull that through. Okay, I get how that $2,500 came to be, because you might want to pay attention to the earnings potential of the associate. It may be growing at a nice rate, leading to a higher and higher amount of net income added on each time. Also, you want to pay attention to the amount of dividends, because that's going to affect our cash flow. This is a non-cash flow amount. We don't get cash flow associated with this $2,500. So if we look at our cash flow statement, there's no cash flow for us associated with this $2,500. There's our cash flow, but that's cash flow in investing activities, right? So this doesn't hit the income statement. So don't get too bogged down with the accounting. Just understand that as you're reading the notes, you have to have an understanding of the language of the accountant to understand what they were doing. Otherwise, you wouldn't. And I think this gives us a pretty good high-level view of what's going on. All right, let's do another example, a more complicated example here. Let's say Jones owns 25% of Jason Company. Annual amortization of excess paid is $8,000, so we don't have to go through figuring out what the excess was and what assets that were attributable to. It's already giving it to us that, hey, look, you're going to take an $8,000 amortization charge that's related to the excess that you paid to get this 25%. And let's follow this example through. It looks messy, but it's actually quite neat. In 2011, Jones, which is us, Jones owns 25, so let's say Jones is us, Jason is the other company. Jones made an inventory sale to Jason of $96,000 for $160. That's what Jason Company paid. Jason paid $160 for stuff we sold him that cost us $96. In that same year, $120,000 of it was sold in 2011, and the other $40,000 was sold in 2012. That's their cost of goods sold. So of the $160 that they paid, they were able to use $120 of it in that year. The other $40 was used in the next year. 2011 net income was $800,000. 2012 net income was $820,000. By the way, this is a kind of scenario that you can expect in level 2 with a lot of moving parts. So you can get it can sound very complicated very fast, but all you have to do is just break it down and solve it step by step. What do we have here? We have a situation where one company owns 25% of another company. We have a depreciation or an amortization charge each year that we're going to take, and we have an unrealized profit, a potential unrealized profit that we have to realize here. So let's go. 2011 Jones equity income. What are we going to show on the income statement? Well, right away, our 25% share. It made $800,000. What do we know right away? Let's assume there was no complication, and this is a great way to approach very complicated problems, to say, I'm going to assume all of the complicated stuff away, and I'm going to look at the very first basic simple thing. I own 25% of Jason Company. Jason Company made $800,000. My first step is to recognize $200,000. Done. So there's your 25% share, $200,000. And you say, but you know what? This little bit is not complicated. I know that I have to reduce it by $8,000, so let me do that right away. There's $8,000. Done. Now let me deal with this unrealized profit. They paid $160,000 for something. They got $120,000 that they sold, so 25% of it was unsold. 25% was unsold. So there's an unrealized profit of 25%. Remember now, we're dealing with Jones here. We're on Jones, right? There's 25% that cannot be claimed. 25%. Well, what was the margin on the sale? It was $64,000. So the margin on the sale was $64,000. Of the stuff that you sold, 75% of it got sold, 25% didn't. So 25% of the 64 is $16,000 of unrealized profit. But you only own 25% of Jason Company, so you only have to take 25% of this amount. I know that sounds complicated. And that's where this is the tripping point. This is the one that'll trip you up. You're probably thinking, wait a minute though. I sold it, it cost me $96. I sold it for $160. I made $64. They sold 75% of it. 25% of it is still carried on. So $16,000. Shouldn't I be reducing my income by $16,000? Well, no. You only own 25% of that company. The other 75% of that company belongs to the shareholders. So you made money off the other 75% of the shareholders. You just can't make money off of yourself. You own 25% of that company. This other $16,000 is a cost shouldered by 100% of the shareholders. 75% of the shareholders will have to swallow their share of your profit, but you can't claim your own profit. If there's $16,000 unrealized profit for the entire company and you own 25% of that company, that $16,000 that you made $4,000 of it to yourself. Do you get that? So you only have to claim the 25%, so you'll reduce it by another 4, you'll show 188. Let's go to 2012. What happens there? First thing, make it really simple. I own 25% of a company that made $820,000. I've got to claim $205. Great. I also know that I got this little $8,000 thing over here, so let me take care of that. Now let me deal with the unrealized profit. They sold the other 40 in 2012, so they sold everything, so I should have nothing. which means whatever I did claim as unrealized profit, give it back to me. You claimed $4,000, give it back to me. There it is right there, 201, you're good to go. All right, let's look at disclosures. We know already it's classified as a non-current asset. We know that income is recorded as earned. Net income before discontinued operations shows up on our statements the same way. Anything from discontinued operations has to show up on our statements the same way, and anything that shows up in the associates' other comprehensive income has to show up in ours. Income recorded as earned by the associate. There'll be a separate line item on the balance sheet and for each income item. So if the associate had something in all three, we would expect to find on our statement something from all three. Or if it's just collapsed into one line item, we'll find all of the detail in the notes. It'd be doubtful that you'd collapse it all into one item because these are very distinct parts of the income statement. But the notes are extremely important in understanding each of the line items. Fair value for any of these investments that have a market price. So in the notes, we will get the fair value because remember, GAAP can elect to use the fair value method. So if you're comparing two companies, one with the equity method, one with fair value, well, in the disclosure for this sort of thing, in the notes, we will get the fair value for any of these investments that have a market price. Information about differences in year ends between the investor and the associate. Just because you're looking at the line item on their statements doesn't mean that applies to the same year end. One company could have a year end of December 31st and the other company might have been November 30th. So that by the time you report December 31st, the numbers you're reporting for the associate are 1 month stale. Because they belong to November 30th. You don't have December numbers. You only have November. So this will give you any differences in the year ends. For IFRS, there's more information. You have to add the information on the associate's assets, their liabilities, the revenue, net income. So you get a little bit more granularity on the associate itself. Okay, and some concluding remarks on any outstanding issues for you as an analyst. Number one, is the equity method appropriate? And this deals with the issue of influence. So you could have a situation where a company owns 19% of another company but has significant influence, but is not using the equity method when perhaps they should. You might have another situation where a company owns 25% of another company but has no influence whatsoever and is using the equity method and probably shouldn't. So let me give you a situation where this would work. Let's say I own 19% of a company and I'm the largest shareholder by far. Even the insiders, management and everything only own 5%. I got influence. But let's say I own 25% of a company where the management team, and let's say it was a family business that went public, they retain 70% ownership, and I have 25%. I got no power. I got no influence at all. I mean, I can say what I like, but I certainly don't have representation on the board that could give me any kind of power to do anything. I have no influence at all in situations like that. So you could have situations where you're not using the equity method and you should, or you're using the equity method because you're over 20%, you follow that rule, but you have no significant influence, so you shouldn't. Investment and associate. It's a single line item on the investor's balance sheet. May not reflect the fair value of the net assets. And again, that's disclosed in the notes, so you might want to make a decision whether or not you're going to pay attention to the fair value or not, whether it matters for whatever company you're looking at. Investment income. The proportionate share is included in net income, but no proportionate reflection in sales. So let's say that I have net income of $100,000. I'll give you a little scenario here. Let's say I had sales of $1 million and net income of $100,000. That gives me a 10% net margin. But let's say that I have my share, my proportionate share from associates was $15,000. So I had 15. I now have 115,000 here. I now have 11.5% because the proportionate share is not showing up in my sales. My net margin is not very informative. And the more I have as far as income from associates, the less informative that net margin becomes. You may want to back it out and just get to the pure operations of the business without all of this added in. And keep in mind, equity method earnings are non-cash earnings. This is a non-cash earning, this extra 15 in here. So the proportionate share that we're claiming, that's non-cash, but the dividends that we receive are cash. It complicates things, but hey, if you wanted an easy life, you could have just stopped at high school and went to work at McDonald's, right? Okay, well now we're going to cover business combinations. So we're moving from influence to control, which means we have to move from the equity method to the acquisition method. For the business combination, for an end result of a business combination, IFRS has no designation or distinction regarding what they call the final entity. GAAP still maintains certain names: a merger, acquisition, consolidation, or an SPE or VIE, a special purpose entity, a variable interest entity. We'll visit that right at the very end. But merger is basically A plus B is just a bigger A. B is gone, A continues to exist. Acquisition is A plus B equals A and B. A and B continue, and you have a parent-subsidiary relationship. We're going to spend some time on this one. This acquisition need not be 100%. You don't have to, A does not have to buy 100% of B. The parent reports a consolidated basis, the parent reports on a consolidated basis. If it is a full acquisition, it's accounted for with the acquisition method, which is what we will cover. If it's a consolidated basis, we'll see how that creates new accounts on the balance sheet, especially one's called non-controlling minority interest. A consolidation, A plus B equals C. A and B are gone, C emerges, and the SPV or VIE, no voting control. And we've seen some of these. If you think about securitization, that's the very essence of it, right? No voting control, but the sponsor company may have control. Not just control, but extremely significant control. So while it's not part of any of the explicit learning objectives here, having a sort of a history of how we got to the acquisition method might be helpful. Pre-June 2001, GAAP allowed either the pooling of interests or the purchase method, as did IFRS. Pooling of interest or the purchase method. Pooling of interest is just the book value of A plus the book value of B, and you're done. You just add all the totals together and off you go. The purchase method was the book value of A plus the fair value of B. And you use the purchase method when the pooling criteria was not met. Now you can see sort of a difference between these on a going forward basis, that if you had a choice between pooling of interest and purchase method and your motivation was to report the highest net income you could, you don't want to revalue your assets and take larger depreciation. You'd rather use the pooling of interests method, right? Post June 2001, GAAP dropped the pooling of interest and went purchase method only. IFRS still allowed for both. After March 2004, IFRS and GAAP both are with the purchase method only. So the pooling of interest was gone. Using the book value of both was gone. You're going to use the book value of the acquired and add to it the fair value of the acquiree. After January 1st, 2013, IFRS is now with the acquisition method. We'll talk about GAAP in a second. GAAP's the same thing, very close to the same thing, but just different language, right? IFRS uses the acquisition method, and control, they redefine control more broadly. GAAP didn't take the broad definition, but specifies control in a very objective way. IFRS does it more in terms of a motivation or a strategic way. The investor has the ability to exert influence on financial and operating policy, and the investor is exposed to or has rights to variable returns. The new policies or the new accounting policies are covered by IFRS 10 and 3 and FASB's ASC 805 and 810 for those that want to know. And GAAP, we'll look at GAAP here. GAAP has two different criteria here. They measure control based on voting. We'll work with the variable interest entity in a second here. Let's just go down to the voting. Voting interest. Control as evidenced by voting rights. So more than 50%, there's control right there. So there's no question about determining whether control exists or not. There's no judgment call to make. In IFRS, there is a judgment call that you can make. For GAAP, there is no judgment call. If it's greater than 50%, it's control. And we'll look at the VIE, variable interest entity. The primary beneficiary of the VIE consolidates. And the primary beneficiary is the party that will absorb the majority of the expected losses or receive the majority of the expected residual returns, which is why they call it a variable interest entity. So IFRS recognizes SPEs, special purpose entities. GAAP recognizes SPEs, but also says an SPE is a VIE if certain conditions are true, and if that SPE is a VIE, the primary beneficiary must consolidate. So there's a test to determine whether or not that SPE would be consolidated on the sponsor's balance sheet, and we'll see that right at the very end. All business combinations are accounted for by the acquisition method. All business combinations, merger, acquisition, consolidation, SPE, all of them are accounted for with the acquisition method. Less than 100%, the parent reports consolidated statements. If it is 100%, there's only one entity. You don't call it a consolidated statement simply because, well, it's 100%. It is one entity. It's one statement. But when it's less than 100%, the parent reports on a consolidated basis. Okay, so let's get right into the acquisition method first. Once we understand the acquisition method, we'll look at a few examples at 100% acquisition. Then we'll look at how it's applied when there's less than 100% acquisition, all right? So both IFRS and GAAP require the acquisition method for all business combinations. And the price paid, which is referred to as the consideration given, both clear and contingent. What this means is, let's say that I pay $100 million for a business, plus some other amount contingent upon some other event happening. That's the price paid. Both clear and contingent is the fair value of the acquisition. There are three issues that we're going to go through in accounting for the acquisition method. Number one, the recognition and measurement of assets and liabilities of the combined entity. How do we do that? How do we recognize them? And how do we measure the assets and the liabilities? Number two, the other issue, the initial recognition and subsequent accounting for goodwill. And number three, the recognition and measurement of any non-controlling interests. We'll cover this when we discuss consolidation, because for the purposes of discussing the acquisition method, we're going to go through some examples where we're just going to assume 100% acquisition. That does not give rise to a non-controlling interest. Only less than 100% does. So I'll cover off 1 and 2 now, but as we move into consolidation, then I'll cover off issue number 3 once we get into that topic. So issue number 1, the recognition and measurement of, and we have to do assets and liabilities, but there's quite a few topics here. There's, I think, 4 different categories of of recognition and measurement. Number 1, let's deal with the first one, the identifiable assets and liabilities. That covers tangible and intangible assets and liabilities at fair value as of the date of acquisition. And here's something interesting, must also recognize assets and liabilities not previously recognized. So we're going to take the tangible and intangible assets and liabilities at fair value. That's what's sitting on the acquiree's balance sheet. Then we're going to say, do you have other assets and liabilities that are just not recognized on your balance sheet? So what's an example of that? You'll recall from level 1 FRA, whenever there was an internally generated brand or an internally generated patent that was not capitalized, it did not show up as an intangible asset. Well, now they do. So when you acquire the acquiree, if there's internally generated brands or patents, you'll try to value those at fair value, and you will put them on the acquirer's balance sheet at that fair value. That's interesting, right? I bet you didn't know that. So identifiable assets and liabilities. What other assets are there? What other assets and liabilities are there? There are contingent liabilities. IFRS says you'll recognize it if it is a present obligation arising from past events and can be measured reliably. And IFRS is all contingencies. All contingencies that you can identify that are present obligations arising from past events and that can be measured reliably. Any expected costs, however, are not included. Only contingencies. The key word here is a present obligation arising from a past event. An expected cost is a future cost arriving from a current event. So a merger, for example, will have future restructuring costs. Well, those restructuring costs are not part of contingent liabilities. They will be expensed as occurred. It is a matter of when the event happened. The event must happen in the past for there to be a present obligation. And for IFRS, it will be all contingencies must be listed. Well, let's have a look at GAAP in terms of its recognition and measurement of contingent liability. GAAP, only contingencies that are probable. IFRS is all contingencies, probable or not. If there's any possibility of them whatsoever, you must list them if they can be measured. GAAP says, hey, only if they're probable and they can be measured. So GAAP, the contingent liabilities on a GAAP basis will be a subset or even a perfect subset of the contingencies listed under IFRS. It can't be greater. GAAP will never have more contingent liabilities than IFRS because IFRS is all of them. GAAP will either be equal to or less than what IFRS has. C, indemnification assets. This is a new word, and it's not that difficult to figure out, but the explanation in the textbook makes it sound much more difficult than it really is. An indemnification asset arises when the seller indemnifies the buyer for the outcome of a contingency. So let me give you an example. Let's say that we recognize that we can recognize and measure a contingent liability measured at $20 million. The seller indemnifies the buyer for all costs greater than $15 million. So I say to the seller, hey seller, look, you didn't tell me about this contingent liability. It could be up to $20 million. And the seller says, no, I don't think it'll be up to 20. Your measurement system is wrong, but I get that you have to use the 20. I tell you what, anything over 15 is on me. I'll cover it. Oh, okay. But here's the deal. I still have to list that contingent liability for what it really is, $20 million. But I now have an indemnification asset to offset the liability so that it is only registered at $15 million net. So I'll still list the contingent liability at $20 million, but because of this indemnification from the seller, I have an indemnification asset for $5 million. So my balance sheet will show an indemnification asset for $5 million, the contingent liability for $20. What's my net result? Anything over $15 million is covered. And our last issue with regards to recognition and measurement of assets and liabilities are financial assets. Well, we spent the whole first half of this reading on financial assets. So we just have to talk about the process of moving it from one balance sheet to another. We're not going to talk about how they're recognized, just the process. They will be reclassified from the acquiree to the acquirer's business model. So the acquiree will have their financial assets listed as either fair value to P&L, fair value to OCI, and amortized cost. Well, when they move over to our balance sheet, perhaps something that's in amortized cost doesn't make sense based on the way we do business. It might be better off in fair value to P&L. So when we acquire another company that has financial assets, we'll take them all, we'll go through them, we'll say, put it here, put it here, put it there, put it here. On our statements, we'll reclassify based on our business model. So there we go. For assets and liabilities, you have to look at the ones that currently exist, the ones that don't exist, the contingent ones, any indemnification assets you get out of the contingent ones, and a reclassification of your financial assets. You need accountants for that, right? Issue number 2, recognition and measurement of goodwill. And goodwill, let's keep in mind, is not amortized, and it's tested for impairment at least annually or more often if conditions warrant. Guess what? IFRS and GAAP are different. Shocking, isn't it? Well, here we go. IFRS has 2 options. Has partial and full goodwill. I actually like the partial better than the full, and when we get to the examples, I'll point out why I like the partial better. But it has partial and full. GAAP has only one option, full. For partial goodwill, the fair value of the acquisition less the fair value of the net identifiable assets. That's it. And I know, again, with accounting, words really are so abstract. I even hesitate putting the words down because they really don't mean much until you see the example. But we calculate it as we take the fair value of the acquisition less the fair value of the net identifiable assets. I'll show you how that's done. For full, it's not the fair value of the acquisition, it's the fair value of the entity as a whole. Less the fair value of the net identifiable assets. So we can see that if we bought 80% of a company, for partial, we would just be using that 80% over here, whereas for full, we would be using the 100%. So let's look at some examples of how we would do this. Let's take an example here. Let's say we spend $800,000 for 80% of the target. If we spend $800,000 for 80%, that implies the fair value of the entity of $1 million. Let's take the fair value of the net assets at $900K. Let's look at partial goodwill. Partial goodwill is the fair value of the acquisition, $800K, minus the fair value of the net assets. Since we only have 80%, that's the fair value of our acquisition, 80%. We have 80% of the fair value of the net assets. 80% of 900,000 is 720. 80,000 is the goodwill that would be recognized. That's partial. That 80,000 represents, we can see from the 900 to a million. This is implying that there's $100,000 of goodwill. But we're only buying 80% of the company. Why should we recognize 100,000 of the goodwill when we're only buying 80% of all the assets? We should recognize 80,000. That's why I like partial. Full says take the fair value of the entire entity. So you have to look at how much you're buying and how much you paid, and you'll get an implied fair value price for the full entity, 1 million, minus the fair value of the net assets. 100,000 is the goodwill that's recognized. Again, I spent 800,000. I spent 800,000. I should have a claim against 80% of the net identifiable assets, 720,000. Under the full method, because my 800,000 is being reduced by 100,000 of goodwill, I'm only applying 700,000 to the value of the net identifiable assets. Doesn't make a lot of sense to me. Why use full? I think partial lines up a lot better, but hey, GAAP uses full. IFRS allows both, so we got to know it. One note to make here. Goodwill implies that we pay more than the fair value of the assets. What if we pay less? That's a sweet deal if we can get it. I mean, that's what everyone looks for. I want to pay less. If the acquisition price is less than fair value, do we have negative goodwill? No, it is called a bargain acquisition. Now this is a real kick in the ass. This really sucks. The fair value of the net assets. Let's say we let's say we bought the whole company for 500,000. Fair value of the net assets are 900,000. What a sweet deal, right? The tax man's going to come along and say, "Hey, I want a piece of that action." And here's how they're going to get it. We take the fair value of the assets, let's say it's 900, minus our acquisition price, let's say we got it for 5, there's 400,000. That's a gain on our income statement. Oh, yes, the tax man comes along and says, "Oh, you got a deal, huh? Where's my share?" All right, let's look at a full 100% acquisition and the impact on the financial statement here. Two companies, Franklin and Jefferson. Here's Franklin's book value, Jefferson's book value, and Jefferson's fair value. Being that they're such blatant American presidential names here, why we're using euros, I don't know, but there it is. Franklin acquires 100% of Jefferson by issuing 1 million shares, par value of €1. And the value of those 1 million shares is $15 million. The market value of those shares are $15 million. So that sets up the value of our acquisition. That's the price we paid is $15 million. From that, we can determine what goodwill is. So let's just go and solve this now. So we have to take the book value of Franklin and add it to the fair value of Jefferson. So cash and receivables, 10,000 plus 3, we'll have 10,3. The next item we get to is inventory, 12,000 plus 3,000. Note that it is plus 1,300 higher. So this will be 15,000. The next one is 27 plus the 45 gives us 31,500. And then of course it totals the assets, but we're not done yet because we have to add goodwill. We have to add goodwill into this. So what's the value of goodwill? Well, it's the fair value of the acquisition. The fair value of the acquisition was 15 million, minus the fair value of the net identifiable assets. And so here's our total assets minus our liabilities. There's our net assets, 5,400. So 15 million minus 5,400, we would recognize 96. It's in millions. I'm just saying 9,600, but that's 9.6 million. As our goodwill, that gives us 66.4 in terms of total assets. So let's go to our liabilities. 8,000 plus 600, 8,600. Next is 16 plus 18 is 17,800. That'll give us 26.4. 66.4, 26.4, we need 40,000 down here somewhere. We have 5 million capital stock, $1 par, but we issued 1 million shares with a par value of $1. So this goes from 5 million to 6 million now. That's 6 million. And our additional paid in capital was 6,000. Of the 15 million, 1 million was allocated to capital stock. So there's 14 million left for paid in capital added to the 6. That gives us 20. And our retained earnings, we only take the retained earnings of Franklin. Once you get to the equity section, we completely ignore the equity section of the acquiree. We only deal with our own equity section. Retained earnings of 14,000. So if you add the 26.4 and all of these numbers, we will get 66.4. Why do we ignore the equity section of the acquiree? Because it's folded into the concept of net assets. One thing to note here, or a couple of things that we want to pay attention to here, notice that our inventory went from 17 to 3,000, so that's plus 13 or 1.3 million. And our property, plant, and equipment went from 2.5 million to 4.5 million, so that's up another 2 million. So the end result here is if Franklin and Jefferson continued on as their own entities, and we added the net income from Franklin to the net income from Jefferson, it would be higher than what it's going to be when Franklin acquires 100% of Jefferson, because the combined company now has an extra 1.3 million of inventory to expense and an extra 2 million of assets to depreciate. So that the entity going forward will actually have lower combined net income. The hope is that Franklin buying Jefferson creates cost savings and synergies that outweigh that. So when we think of two companies joining together that, it would be accretive to earnings, we could just simply add the two earnings together. That may not be true if fair value sets up higher depreciable assets or revalues the inventory upwards. So we have a good understanding now of the acquisition method, and we're going to move on to the consolidation process. And the consolidation process is really for acquisitions that represent less than 100%. We need to combine the statements of the parent and the subsidiary. The parent does the consolidating, by the way. So combine the statements of the parent and subsidiary as if they were one economic unit. Transactions between the parent and the subsidiary are eliminated. These are called intercompany transactions. We've seen this before when we looked at upstream and downstream transactions at the associate level. Well, it's the same thing with when control is present when it's a subsidiary. It avoids double counting and premature revenue recognition. Remember, we can't claim that the unearned or unrecognized profit. Business combinations less than 100% of acquisition, but greater than 50%, the parent consolidates. Doing so introduces something called a non-controlling or a minority interest. If we own 100%, we don't have to deal with anybody. It's all ours. But if we only own 90% of a target and we're consolidating 100% of the statements, 10% of what we're consolidating doesn't belong to us, so we have to give it back. At the bottom of the income statement, we got to give it back, saying, look, this is not ours. And in our equity section, we got to give it back as well. That's what that is. That's all that account is. It's the portion of the subsidiary's equity that is held by third parties. So we have to reduce our net income by the amount that doesn't belong to us and reduce our shareholder equity by the amount that does not belong to us. IFRS and GAAP are similar in this respect. Okay, continuing on with the non-controlling interest. It is presented on the consolidated balance sheet as a separate component of stockholders' equity, but there's a little bit of an issue, and this brings in issue number 3. Remember, we said there were 3 issues that we had to deal with when we used the acquisition method. This is our 3rd issue. You'll recall that IFRS and GAAP differ on the measurement of goodwill. IFRS will allow partial or full goodwill, whereas GAAP only allows full goodwill. So there is a difference in the amount of non-controlling interest, the amount that's recorded on the balance sheet, depending on the type of goodwill recognition that you're using, or the goodwill measurement that you're using. So, rather than talk about it, let's just look at an example. January 1st, 2012, parent company acquires 90% of the shares of subsidiary company for 180,000 euros, no par common. The fair market value implied by this, if it's 90% for 180, we're implying a fair market value of 200,000 for subsidiary company. So let's look at how we would measure. First, we'll measure the goodwill, the partial and full, and then we'll go through an example where we see what happens to the minority interest amount. So again, that's our scenario. Parent company acquired 90% of the shares for 180,000 euros. So it implies 200,000 for subsidiary company as a whole. So what is our partial goodwill? What is our full goodwill? Well, partial, remember, we're just dealing with how much did we pay. We paid 180,000. And we bought what, 90% of the company. So what's the fair value of the net assets? 160,000. So 90%, 160,000 times 0.9. So it's 180,000 minus that, and we'll get 36,000. For full goodwill, you're looking not at the amount that you bought, but the implied value of the whole company, which is 200,000. And you're going to subtract the fair value of the assets unadjusted, and we will get 40,000. So partial goodwill will recognize 36,000. Full goodwill will recognize 40,000. There's a difference of 4,000 between the two. So that difference of 4,000 should filter down to the difference between non-controlling interest. There should be a difference of 4,000 there, and let's see if that actually happens. Okay, so let's combine them. Let's do the combined statements using the acquisition method. We'll do partial and we'll do full. Remember, partial goodwill was 36,000, full goodwill was 40. So let's go. Cash and receivables, we take the parent book value plus the subsidiary fair value, we get 55. And for full, it's the same thing, 55. For inventory, we have 125 plus the 80, that's 205. And it's the same for both, 205. Property, plant, and equipment, 235 plus the 155 will give us 390. And that is the same on both sides. Now we add our goodwill amount in here. That's 36. Here it is 40. There we go. So this will give us 686. And this will give us 690. Let's do our liabilities now. 55 and 20 gives us 75 for both. 120 and 70 give us 190 for both. So that gives us 265 for liabilities on both sides. Now we will do our capital stock. We have 87, but we spent 180. We acquired 90% of the shares of subsidiary for 180. We're using no par common stock. So the 180 adds to the 87. We'll get 267 in both cases. And we keep the same retained earnings in both cases, 138. So we can see, this is 690, this is 686. We can see for the two to balance, one side must be 4 higher than the other. So we will need 20 over here to balance, which means we'll need 16 over here. This will give us 686, and this will give us 690. Now we didn't have to do it this way. This is the non-controlling interest. We could have figured it out very easily what the non-controlling interest was. We didn't have to do it this way. What is the non-controlling interest for partial goodwill? Since we claimed 90% of all of their net assets, 10% of their net assets don't belong to us. The net assets are 160, 10% is 16,000. That doesn't belong to us. For full goodwill, we use the full implied value, the full market value of the firm as a whole, 200,000. And since we have 90% of that 200, 10% of it doesn't apply to us, so 10% of the 200 doesn't apply to us, which is 20. Either way that you get to it, you can get to it by calculating everything you need and filling these in to balance, or you could just say, well, partial uses the net assets, so 10% of that doesn't belong to us. Full uses the full market value of the firm, so 10% of that doesn't belong to us. You can get to it either way. All right, let's look at the income statement here, and what we're looking at here is just the subsidiaries income statement. This is we haven't consolidated anything. This is just what we expect to find on the subsidiaries income statement. So we'll look at full goodwill and partial goodwill. Sales of 250, the same in both. Cost of goods sold, the same in both. Interest expense, the same in both. Depreciation, the same in both. Income from continuing operations, the same in both. I think you're getting the picture here, right? It doesn't matter if it's partial or full goodwill that the parent is using. When the parent consolidates the income statement, regardless of what they're using, nothing changes. There are no changes that need to happen here. So the non-controlling interest will be $63.50 in both cases. So you have to have the acquirees or the subsidiaries' income statement first. You must determine what the non-controlling interest is first based on just the subsidiaries' net income, then you would combine it. If you combine the two, well, how much of the combined net income belongs to the subsidiaries' shareholders? Because you're combining 100% of the subsidiaries' income statement with 100% of the acquireds or the acquirers, the parents' income statement. None of the parent belongs to the subsidiary. So you'd have to know this number first. You'd have to know this 63.5 to be able to get the 10%. Then you'd consolidate, keeping in mind this number, and subtract this number from the combined total. It will, when we look at this income statement here, again, this is the subsidiary, it looks the same. They're identical. However, keep in mind that once we consolidate it, we're consolidating it with the parents. Some of our ratios might be off, especially ratios that combine numbers from the income statement and numbers from the balance sheet. Specifically, return on assets and return on equity. So without combining, let's just look at the 57,150 under full goodwill and partial goodwill. And again, I want to stress this is just the subsidiary's income statement. If we looked at return on assets, under full goodwill, you'll recall the assets were 690. Under partial goodwill, they were 686. Well, 5715 divided by two different denominators gives us different ratios, 8.28 versus 8.33. Return on equity we can see is 13.45, 13.57. Now, this is small simply because the difference between the goodwill amounts are very small. There's only 690 to 686. But you can imagine a situation where instead of 90%, we only bought 52%, and the difference between the two ratios would widen. However, let's keep in mind something here. This is just the subsidiary. By the time you add the income from the parent to each of these numbers, these ratios would get closer and closer together. They wouldn't get further apart, they'd get closer and closer together. Why? Because it would only be the numerator that's increasing. The denominator wouldn't change. This is the denominator for the parent on a consolidated basis, and this is the denominator for the equity on a consolidated basis. But this is the numerator is just the income for the subsidiary. Once you put the income on a consolidated basis, these small little differences wash out. So while there is a difference on the ratios, only in extreme circumstances would that ratio matter. And then at that point, you'd need to be aware that, well, the ratio might not be comparable across other firms because of this little issue. But I do want to stress that for the most part, it would tend to be quite small, the differences between them, 8.28 to 8.33. For example, in this case, even if the denominators were wider apart, by the time you add the full numerators, the full numerator will pull it closer together. All right, let's look at goodwill impairment and how this would show up on the statements. And surprise, surprise, IFRS and GAAP are different here as well. Goodwill is tested annually. If it's impaired, it's written down, and that write down is non-reversible, so it can only go in one direction. Once you get to zero, that's it. You're done. IFRS at the time of acquisition, the total goodwill that we recognize is allocated to each of the acquirer's cash-generating units that will benefit from expected synergies. So that really requires some thinking, right? The acquirer's cash-generating units that will benefit from expected synergies. Maybe there's only one. That's the simple thing, right? There's only one, so total goodwill goes to one. But what if there are two? Or what if there are three? Well, total goodwill is allocated to each of these. And the recoverable amount per unit is compared with the carrying amount per unit. So if there's goodwill impairment across, let's say you had a $3 million in goodwill and 3 cash-generating units, each of them got $1 million, but only one of the units was impaired. The other two would stay intact, the goodwill would stay intact, and only the goodwill on one would be decreased. The recoverable amount per unit is compared with the carrying amount per unit, and the loss is applied to goodwill for that unit. Once the carrying value equals 0 in that unit, the remaining loss is allocated on a pro rata basis. The loss is reported as a separate line item on the consolidated income statement. Whatever write-down you have of the goodwill is reported as a separate line item on the consolidated IS. All right, so GAAP is sort of along the same process. There is an allocation of goodwill, but instead of to cash-generating units, at the time of acquisition, total goodwill is allocated to each of the acquirer's reporting units. And then the test is the same. The carrying value of the whole reporting unit is compared with its fair value. If there is an impairment loss, in other words, if the carrying value is much higher than the fair value, the implied fair value of the unit's goodwill minus the carrying amount. And this is applied to the unit until it equals 0. Once goodwill is equal 0, that's it. And again, the loss is reported as a separate line item. I know this doesn't make a lot of sense in words. It looks better in an example, and we're going to do an example. I'm very clear on that throughout FRA, that the words really don't add a lot of value. So if I don't spend a lot of time on them, don't say, well, you brushed over that really quickly. It's because it explains itself so much better in an example. All right, we'll do IFRS first, and then we'll do GAAP. So IFRS, remember, it's cash-generating units. So let's say we have a cash-generating unit with a carrying value of $1.4 million, and that carrying value includes $300,000 of goodwill. And we'll have two scenarios here. We'll have the recoverable amount at $1.3 million and the recoverable amount at $800,000. In both cases, we have impairment. Fair value of net assets here is $1.2 million. Fair value of net assets here, $1.2 million. Under IFRS, who cares? We don't care about the fair value of the net assets. They're not important. Under GAAP, the fair value of the net assets become important, but right now, who cares? So it's just in there as extra information. You got to be able to do that. You got to be able to look at 12 pieces of information, say, I only need 3 of them. Which 3 do I need? And ignore the rest. So let's see what the impairment loss here. We just compare the recoverable amount, it says 1.3, with the carrying value, it's 1.4, negative 100. There's our impairment loss. So the new carrying value is now 1.3, not 1.4, and includes $200,000 of goodwill. That, I think, is fairly straightforward. Let's go over here to $800,000. The recoverable amount is $800. The carrying value of the assets are 1.4. We have negative $600K. That's our impairment loss. The new carrying value of the cash generating unit is $800,000, includes 0 of goodwill. The other $300,000 is allocated to other units. Okay, let's look at GAAP. But GAAP uses reporting units. Same scenario, carrying value $1.4 million, includes $300K of goodwill. We'll look at 2 scenarios where the fair value of the unit, of the whole unit, the reporting unit is 1.3 or $800,000. And here we're going to look at the fair value of the net assets, and it's given $1.2 million in each. We had that information for IFRS, just we didn't need it. For here, we're going to need it. So GAAP first asks a question. Since the fair value of the unit is less than the carrying value, there is a potential loss. So we take the fair value of the unit at $1.3 million minus the fair value of the net assets, $1.2 million. That implies goodwill of $100,000. So we first have to figure out what the implied goodwill is, right? We have implied goodwill of $100,000. This included $300,000 goodwill. So the current goodwill was $300,000. The fair value of the unit and the fair value of the assets implies that there's $100,000 of goodwill. So the impairment loss is $200,000. Under IFRS, the impairment loss was $100,000. Here, the impairment loss is $200,000. What if it were $800,000? Well, the fair value of the unit is $800,000 minus the fair value of the net assets, 1.2. So the implied goodwill is negative $400,000. So current goodwill was $300 minus the implied goodwill of $400. We just go to 0. We don't go to negative. The impairment loss is the full $300, and we stop right there. So GAAP will give us a bigger impairment loss under the same scenarios when there's still some positive goodwill left, but will give us a smaller impairment loss than IFRS will when there is negative goodwill implied by the difference. We don't have to take the extra, there'd be an extra 100 here. We don't have to take the extra 100 and apply it anywhere else. Remember, under IFRS, this scenario produced $600,000 in an impairment loss, but under this scenario here, it only produced $100,000 in an impairment loss. So we do have to pay attention to the difference between IFRS and GAAP when it comes to an impairment loss. All right, we'll look at the special purpose entities and the variable interest entities. And this, honestly, in my opinion, is a pretty interesting topic. SPE means special purpose entity. IFRS and GAAP both recognize a special purpose entity. VIE is a variable interest entity. That's GAAP only. So, briefly, let's say that we have a company and we have a special purpose entity. The company can transfer assets to the SPE, or the SPE can just go out and buy the assets the company needs, but we'll assume the company transfers assets initially. The SPE can get outside funding by issuing bonds. That's the whole idea behind securitization. Maybe there's an equity interest in the SPE, an outside equity interest that might be 3% or 5%, but the vast majority of the funds provided is outside funding. Sometimes the company can provide the equity directly to the SPE, so it might transfer $100 million of assets and go out and raise $95 million of funding, thereby leaving 5% of the assets, 5% of the equity to the company, and it would go outside, raise outside funding. Typically, on the SPE, there are strict limits placed on the governing board of directors. This is a separate entity altogether with its own board of governors. There would be strict limits placed on what they can and cannot do. The SPE then grants the company the right to use the assets. The company then pays a rent or a lease fee to the SPE, which then satisfies the debt financing. Why do this? Why does the company not just raise money on its own if it needs money? Why bother? Because it's making payments to the SPE. Why pay the SPE when you could just pay the bank, right? A number of reasons. The company may not be able to get the financing. It may have to pay a higher cost of debt to get that financing. It may already be leveraged. By transferring the assets into an SPE, a separate entity altogether, remember, these are bankruptcy remote. So if the company goes down, those assets survive outside of the company. It can obtain outside financing at a lower cost of debt. Not only that, it's off the balance sheet, so is the debt. So now it has a lower amount of assets on its balance sheet, so its return on assets looks really great. It doesn't affect any of its solvency ratios or its debt ratio, simply because this is outside of the company. The company is called the sponsor and typically retains significant beneficial interest in the SPE, even though it may have little or no voting control. Well, this was a big issue with Enron. Is a whole bunch of these things off balance sheet, right? Companies were able to avoid consolidation, and transferred assets were recorded as sales. The company has $100 million of assets. It needs to raise money. What it does is it sells the assets to the SPE. Guess what? Its gain on the sale of assets or disposal of assets looks incredible, right? And its return on assets looks great because it's even lower. So a company can really groom its balance sheet and its income statement by using these SPEs, and still without having control, even if they own 3%. Well, that's not control under GAAP. IFRS looked at that and said, now hang on a second, the spirit of control is still there, even though the legality of control is not there. So we're going to change it. If you got this funny business going on, you got to consolidate. So we mentioned this earlier, IFRS 10, after when we talked about the evolution of how we accounted for business combinations. We went from pooling of interests to purchase method to acquisition method. And the first thing we dealt with there is that IFRS has a new definition of control. And that definition of control now encompasses SPEs. So they don't even change the name. An SPE, if the definition of control is there, it has to consolidate. GAAP uses a different term. It uses the SPE, but when the SPE matches the definition of control under GAAP, they refer to it as a VIE. So it uses VIE when control is present. So it has two different words for it. It'll use SPE. SPE is non-consolidated, but if the SPE qualifies as a VIE, then it is consolidated. So an SPE is a VIE when Number one, the total equity at risk is insufficient to finance the activities without outside financial support. That's the whole idea behind securitization. Again, if the company transfers $100 million of assets, I'll write this down so we can see what's going on, transfers $100 million of assets into the SPE, and the SPE then raises $95 million, then the company has a residual $5 million. Now, if the company had just put $5 million to the SPE and went to the bank and said, we'd like to use this $5 million to borrow $95, it wouldn't have happened. So that qualifies. The total equity at risk is insufficient to finance the activities without outside financial support. That's the whole idea behind securitization. So one, all SPEs look like that. That's the definition of the SPE. Number two is where it turns. The equity investors lack the ability to make decisions. That's typically what's set up within an SPE. The board of governors are severely restricted in making any kind of decisions. The equity investors lack the obligation to absorb losses or the right to receive returns. So if there are outside equity investors in here, they lack all of these things because the company pretty much controls everything. To get these equity investors in here, typically the company indemnifies them. So if that kind of situation is going on, where the equity investors lack the ability to make decisions, lack the obligation to absorb losses or receive returns, in other words, they have no variable interest, then the SPE is classified as a VIE for the parent, and they must consolidate. The primary beneficiary of a VIE must consolidate. And the easiest way to tell who the primary beneficiary is the party absorbing the majority of the losses. So let's look visually at a situation that would classify as a VIE. So what we have here is an SPE. Let's just look at the squares and the arrows, and I'll explain the writing as we go along. And we'll see at each stage what criteria are being tripped up to turn this SPE into a VIE. So we have the SPE over here. Minimal third-party equity is involved. The SPE borrows from debt markets and builds or acquires an asset, and it can do that at a lower cost of debt. That's why we use it, right? The sponsor retains the risk of default, and the sponsor makes cash lease payments used to pay off the debt, plus to provide a return to the equity holders. The SPE leases the assets to the sponsor. The SPE leases assets to the sponsor. If this is the situation where you have minimal third-party equity in the SPE, where the sponsor retains the risk of default, a situation like this, the sponsor must consolidate. Why? Because the sponsor has all of the variable interest. Since it retains the risk of default, it absorbs the majority of the losses. It's paying the lease payments to provide a return to the equity holders and to the debt holders, but it's doing this in such a way that if it tried to do it on its own balance sheet, it would have a higher cost of debt along with this. That's why we use minimal equity. Remember, the weighted average cost of capital is a combination of the cost of debt, the after-tax cost of debt, and the cost of equity. Well, the cost of equity here would be very low because you have assets that are bankruptcy remote. And it's very minimal, especially if you're using like 3%. If you're down to 3% on your equity and 97% of a debt, you're pretty much going to be dominated by the lower cost of debt in this situation. So even though the sponsor is making payments to compensate the debt holder and the equity holder, it's still doing so in a way that would be lower than if it kept it on its own balance sheet. Now, the end result of consolidation, the sponsor's balance sheet will look the same if it borrowed to buy or used the VIE or SPE. That's the end result, but with one benefit. Now you may think, well, why go through all of this? If you have to consolidate in the end, why would a company go through that? Isn't the point of doing this to boost your own financial picture? Well, you are in a way. You still are. Even by doing this, you're still getting a better deal out of it because of this thing right here. Your lower cost of debt that you can get by using the SPE. So even after you combine, they will not be absolutely identical. But the balance sheet will look the same if it did. If it borrowed to buy or use the SPE, because it would have to recognize this debt as a liability and would have to recognize the assets as its own assets. So it would have to do the same thing anyways. That takes us through this reading. There are some loose ends that you can read up on, some little issues that about this and about that, but they're so minor. They're 2-3 sentences each. They're not in any of the learning objectives, and they're really not worth getting into. But for those who are interested, well, you've got the books in front of you. Read away. But again, we've covered what you need to know to get into your level 2 exam.